Good afternoon, everyone, or morning or evening, depending on where you are in the world. Welcome to episode 25 of the Relentless Trading Lounge. Is that what we called our podcast? It is. And for those watching on YouTube, we've got our cameras on this week, which is what we've been doing moving forward. You may notice that there is three of us this week. And so welcome, Rachel Freeman, to the podcast.
Thank you for having me.
You are more than welcome. Vicky will give us a brief intro as to why you're here today. No pressure, Vicky. How are you, Vicky?
Yeah, I'm good, thank you. And thanks to Rachel for jumping on. But yeah, we just had some questions from people in the community asking for some general advice around, what's best for profitable traders in the UK, how best to sort of set themselves up in terms of, from a tax efficiency point of view, is it better to go down the sole trader route or limited company? So that's kind of where the idea was, to see if we could get you on.
First of all, from a legal standpoint, anything that you hear or watch in this podcast is not bona fide tax advice. It is not legal advice. Please speak to your own tax advisors. Rachel is from Freeman Accountancy, and she does all the accounts for Relentless. So we've been working with her 3 + 4 years or so, but we were just going to throw some random questions out at Rachel. But Rachel, do you want to give us a brief background about yourself, where you're based, how long you've been involved in Excel spreadsheets for, and all that jazz? I don't know how it works.
So I've been doing this for 20 odd years. Wow. We're very much general practice. So we've got clients of all shapes, sizes, types of businesses. We cover everything from a little one-man band investment, just needing a tax return, right the way up to clients with multi-million turnovers, and pretty much everything in between. Based in the centre of Oldham, just outside Manchester, which doesn't sort of restrict us for acting. We've got clients all over the country with meetings like, Zoom and so on these days. Just a nice, friendly, personal service.
Happy days. And again, from a personal point of view, as I say, Rachel's always done our accountancy stuff and is a brilliant accountant and helps us out huge amounts. And a lot of the stuff that we think, and I think this comes from a lot of our traders and a lot of the people in the community. So if you're a member of Relentless, all of Rachel's details are in our Discord channel. We will also put in the YouTube link how to get in touch with Rachel if you're not a member of Relentless, but you want advice on how to set things up. But when a lot of people get involved in trading and we go through the sort of journey, you learn how to trade, you practice on a demo account, and then what you can do is be a trader for a prop firm. There's numerous prop firms out there. We spoke about this the other day. There's obviously Relentless. We have our own prop firm now, FTMO, Fivers, etc. But people could end up managing 6, sometimes 7 figures as a contractor. And the first thing they worry about is, well, I don't know what I'm going to do with that money. So feasibly, when you're a trader, the contract that you sign with the prop firm states that you're a contractor for that prop firm. So I guess the first question would be, when you first become a trader and say you've got, between 1,000 or 5,000 or 10,000 coming in each month from these different companies, what do people do? I think a lot of people are scared of the government and HMRC and those brown envelopes that turn up every now and again and don't know what to do. So I'll throw a really horrible question at you. If you are, say you're running you have your own PAYE job and you're starting with a small account and you're doing trading as a side hustle. So say you're employed by an employer and you're getting an extra £500 or £1,000 a month coming into your account. What should they do, or what could they do when they're first starting?
So I think the first thing is to take advice. A lot of it does depend on your personal circumstances. So you say in pay as you earn income. If you were earning 20,000, the advice is completely different than if you were earning over 50,000 or 50,000 on pay as you earn.
Okay.
So just because of the rates of tax, so the 50,000 you're hitting higher rate tax. is this all? Can you overhear this conversation?
No, you're fine. You're fine.
Okay. So it depends on the personal circumstances. There's not sort of a one rule for everybody that sort of suits. If you were earning less than the 50,000, so say 20,000, I'd probably say do it on a self-employed basis. You can offset your expenses against that, and then you'd be taxed on your net profit of that. If you were earning 50,000 or more, I'd probably be suggesting doing it through a limited company, just because it gives you a bit more flexibility on when you draw your income, if you want to draw your income, whether you want to leave it into a pot to draw down on, once it's built up, but it's very much depending on your personal circumstances. A lot of people do this type of thing as a side hustle, so they don't particularly need the money. So again, limited company is possible a way forward, but it is very individual to your own circumstances. Even things like child benefit can be affected if you're not careful.
Yeah, you've got to give that back.
They are changing the rules on that, so it's not quite as bad as it used to be. But it does a massive impact on all sorts of things. So it's individual advice, really.
Okay. So if you were, say, a policeman or a nurse, or you worked, I've no idea, in Costa or something, and this was coming in, the trading income was coming in as a side hustle effectively, depending on your circumstances, you might be better off setting up a limited company, and then could you take dividends, is it, from that?
Yeah, so the different options, because the company is taxed on the income, you can leave the money in the company until if and when you need it. If you wanted to take a bit, you can take it out as dividends. If you didn't have a pay-as-you-earn job or very minimal sort of, say, self-employed work, you could then put yourself on a payroll through the company. So it is very, very complex. It's not to us because we do it day in, day out, but to tailor make it to your circumstances, you've just got to get it just right. And everybody's doing it for different reasons.
Okay. And in terms of, we've bought lots of things as a company, and we'll go to companies and they'll go, oh, it's this amount plus VAT. And we go, can't you just tell us what the amount is? How does the VAT thing work, and what is VAT, and why do people put the amount of VAT on after it and then say you can claim it back? I just don't fully understand what VAT is.
VAT registration. So not every single business has to be VAT registered. It depends on the type of work they're doing and depends on the turnover. So if you're a company that is doing something that has to be VAT registered, like me, as soon as my turnover hits £90,000, I've got to be VAT registered. Used to be 85, but now it's 90,000, and that's just the law. You have to be VAT registered. Again, there's tons of different bits of VAT registration. It should be on anything that's a service or a luxury. That's generally what VAT is charged on. But anybody that's got a turnover approaching 90,000 should have a conversation again about, from a VAT point of view, whether you do or don't need to be registered.
And it's right, isn't it, that when you become VAT registered, so you're paying that out, but you can also reclaim it back, can't you, on any like purchases that you make?
So there's different schemes for VAT, but generally for most people, you're VAT registered, you charge 20% of VAT on more or less everything. I'm saying more or less because again, there's these little quirky rules. I don't want to bore you all day. And then you reclaim the VAT on things that you pay out VAT on. So your phone bill, your accountancy fees, that type of thing. And then you would pay the net over to HMRC.
And with regards to paying, so say you were set up as a limited company, do you pay, is it corporation tax? You pay on that as well?
So limited company pay corporation tax. That's 19% on profits up to 50,000. Anything over above 50,000, between 50 and 250,000, it's tapered. None of these are straightforward answers, are they?
No, I know.
I know.
This is why it's horrible.
So if your profits were more than 250,000, it's a flat 25%. And anything between that 50 and 250, it sort of tapers up to the 25%.
Okay. So even though it sounds like I'm paying out a lot of tax, it's still potentially, I know everyone's different and none of this is legally binding. If you're bringing in between 10, 100, 200,000 as a trader a year, being set up as a limited company, even though you're going to have to pay corporation tax and VAT, it's still going to be more tax efficient potentially than any other, like a sole trader or is it a partnership?
Yeah, so there's different ways of doing it, but that so if you were sort of earning that level of money as a sole trader, you'd be paying 45%, you'd be losing your personal allowance, and these things all sort of they're the negatives of having it in your own name, and that's the same for a partnership. All a partnership is two sole traders stuck together, or multiple sole traders stuck together, so the rules are the same.
Okay.
Is there any situation where you would use it as more capital gains?
I've heard about this recently in the news and capital gains tax. What's that?
Yeah, so capital gains tax is if you made a one-off gain, so you won't do it. So somebody like me, perhaps if I decided to dabble in it, you say, right, okay, you're going to do it as a one-off. The capital gains doesn't just apply to this. It applies to if you sell certain houses, shares, that type of thing as well. So capital gain tax is a tax on a gain rather than your income. So nothing that you're particularly earning. And that's the differential, that if you're doing this to a tune where it's classed as a trade, that's then becoming income and liable to income tax or corporation tax if you decided to do it through a limited company. Whereas capital gain is more one-off chunks of, like I say, shares, anything along those lines, an asset that you're selling and making a gain on.
So, for example, and this is a horrible question for you because you might not know the answer, but say I bought £1,000 worth of Bitcoin, say 10 years ago, and that is now worth, can't remember what it's gone up by, but by a lot. So say that was now worth
$1 billion.
$500,000.
Yeah.
And then I sold that. If I, and rightly so, chose to declare that to HMRC, that would be a capital gains tax on that. Because effectively, it's a share, is it? Maybe, I don't know.
It's a bit. The key bit there is that it's a one-off thing. It's not something. So if you were buying 1,000 shares, that's it. You're not trading constantly, and you're not trying to earn a living off that. You just happen to have got lucky on one investment. That's all.
Yeah. So because I'm not trading someone else's capital and splitting the profit, and it's not my day job, it's a separate thing.
And because you're not doing it repeatedly, even if you sort of say it as a side hustle, the phrase you used earlier, you're still doing it to make a profit as a regular sort of form of income. You're not just doing it as a one-off investment in the same way that you might buy normal shares or a property to rent out. It's more that one-off stuff. Again, there's more to it, and obviously in individual circumstances, but that is generally the gist of it, and that's when it would fall under capital gains tax.
And in terms of, there must, at the moment, we've talked about capital gains tax and VAT and corporation tax. Is there a plus side to all of this, being able to set up as a potentially a limited company, in terms of if I buy myself a shiny new monitor or my subscription to an education platform like Relentless, for example, or an indicator or something like that? What's the upside of if you go and visit a client or you travel to a mastermind, or what's the upside to this?
Okay, so we've just talked there about receiving the income and profits, but the thing you want to be doing, or most people want to be doing, is reducing your profits, therefore your tax position. So you start off with your top line of your income that's coming in, then you've got things that you can reduce your income by. So like you say, things like travelling, phone bill, internet subscription, monitors, headphones, all of the things that you sort of need to do your job, or that, that particular sort of business that you're trying to run. All of those things can come off that, which then reduces your net profit and therefore your tax position. There's no set rules of this is that everybody seems to think there's a list of expenses that you say, these are the expenses you can claim. It's not. It's just more or less, is it to do with my work? Do I need it to work? Do you need your headphones for this podcast? And it's that you sort of, and sometimes you need to sort of think outside the box a bit, that you think, my iPad, well, I'd buy an iPad anyway, but it's not. If you're using that iPad to work on, absolutely fine to claim it. But generally we chuck that back at clients to say, do you use it for your work? Do you use it for your business? And in short, if you do, generally you can claim that.
So things like cars, or is that again complicated?
It is, of course it is, yeah. Throwing money somewhere. So again, electric cars, absolutely perfect. So you could put an electric car through your business, that's absolutely fine. If you bought a more standard car, like an Audi or BMW 3 Series, something like that, that becomes a company car, which is the same as an electric car, would also be a company car. But with a standard car that's petrol or diesel, you then be coming into the company car rules, which becomes incredibly expensive from a tax and national insurance point of view.
Okay.
So an Audi is an example that might be worth £45,000, even if you've only paid £10,000 for it. That you're still taxed as though it's on that, and it's a percentage based on the CO2 emission. Company pays national insurance, and you pay tax from your point of view. So generally cars, not very good. Electric cars are the exception. Commercial vehicles are also the exception. Things like your double cab pickups, the Nissan L200 type of cars. Vans are fine. But yeah, cars, again, another grey area. You'll never, ever get a straight answer. You should know that by now.
You should go into politics.
Yeah, absolutely. Yeah, I'm not going to answer.
And in terms of, because we've touched on politics recently on the past few podcasts, and again, it's just I'm interested in other people's opinions. It looks like Labour's going to get into power. Is that from an entrepreneurial point of view? Is your personal view on that it could be a good thing, or do you think it'd be a bad thing? You'll be reading stuff around tax and HMRC, and you must have some industry ideas or models. What's the general feel?
I think it probably depends on what end of it you're talking about. Okay. So if you're talking sort of average working class without huge amounts of money, not sort of, massive, I don't know what they sort of count as what they're calling a big income. I would say they're probably going to put little bits of incentives in. But I think where they are going to feel, and if Labour, I was going to say when Labour get in, if Labour get in, I think they're going to look at the higher end wealthier people. And I think that's where they'll be looking. They've already mentioned that they're going to change the rules on pension. So there's something called a lifetime allowance on pension. That at the moment, if they're saying that that's going to come back in, and that will make a big impact on people's tax position. So again, it's my opinion, but I would have thought it's going to affect the wealthier people more negatively than it will your sort of lower, sort of more average earners, if there is such a thing.
And just touching on pensions then, am I right in thinking if you had set up a limited company for your trading income to go into, you could then put money from that into your pension? Would you get tax relief on that?
Yeah. One of the things we do with our clients is if you were setting up a limited company, you've got a set year end. So if you set a company up now in June, your first year of accounts will be running to June next year. So what we tend to do, either before the end of the tax year or before that date I've just mentioned, we have a conversation with you to say, look, your tax year is coming to an end. I think we did it recently that, do you want to be paid into a pension? Do you need a new laptop? Do you, what vehicle you're driving? And all of those things, because they are all good ways to reduce your tax position. So if you knew you'd had a particularly good or profitable year, it makes perfect sense to be getting rid of the money where you can do, obviously for useful things, not just for the sake of it, but do that prior to year end just to reduce your tax position. Or bring it forward, something like a laptop you might be thinking about over the next few months, makes more sense to do it now before the year end.
And in terms of just touching, because I'm getting old now, you touched then briefly on the lifetime allowance for a pension. What is that?
So you, each year, and I'm not a pension advisor, but each year you're allowed to put £60,000 into your pension.
Wow.
If you don't use allowances from previous year, you can carry that forward. But there is something in the background, not at the moment because it's not in place, but they are threatening to bring it back if Labour do get in, where you've got a maximum lifetime allowance. I think it's 1073 treble O. So if your total pension pot is more than that, when you start, you actually get penalised for that, and they create a tax charge on it. So that's the bit that they're talking is going to change, and that will make a huge impact to certain clients. There's not a lot of people, to be fair, these days that have got a pension pot of that size. A lot of people that are investing that much into a pension tend to keep it at the 60,000 a year up to this lifetime amount, and then probably invest in something else, whether it's shares, crypto, whatever it is, property. So it is fairly unusual, but it does happen, and it will penalise them probably to the tune of 50% of what they draw down on the pension. So it's a big chunk.
And they can do that retrospectively, because it seems unfair.
They can do. I don't think they will do. Okay. I think they will say from now. But really, that sort of effectively is retrospectively, because you've already put that much into your pension. So people that have got a pension pot of that value, when they took the allowance away and said that, right, that doesn't matter, you're not going to get penalised for that. If they bring it back in, it sort of almost is retrospective.
Yeah.
But I think that's going to be one of the first things. and it's not going to make a majority of people grumble and complain to the newspapers and the media, because it doesn't, it affects the minority really, that. So I think that's going to be the first change.
Yeah.
I think there'll also be changes to perhaps things like inheritance tax, capital gains tax. They target it as the wealthier end of taxes, which is not in real terms, but that's what they're sort of looking at, and that's what Labour's all about.
And just briefly on the societal
Nice.
stuff, I know you've been an accountant for 20 odd years now. Have you noticed that things have changed in terms of, people used to just have a job and that was fine? And are lots of people doing more, whether it be side hustles, MLMs, trading? Have you seen that growth where people are trying to do 2 or 3 different jobs just to not to put £1 million in their pension pot, but just to try and make ends meet? Has that been noticeable for you as a firm?
Yeah, and I think it's partly a financial thing that people need to earn more money. So years ago, earning £40,000-50,000 was quite a good salary. This year, at the moment, it doesn't go very far. So I think people are doing it where they need to top up the household income. It may be that sometimes, you've got a wife that earns a very good salary, husband's perhaps stayed at home. And that even that money that she's earning that's sort of a good salary isn't necessarily enough to sort of, it might cover the basics of the household expenditure, but it doesn't sort of stretch to the holidays and the nicer car than they've got. And so, no, I think we're seeing that partly from a cost of living side of it, I suppose, that people need to earn more because the money isn't going that far. We've also seen people that were going to retire that have extended their retirement period because they've said, now our pension, at the time we were talking about it 5-10 years ago, we did have enough in our pension pot to retire, or we could live on our savings or whatever it is, and money just isn't going as far as it used to. So no, I think we're seeing a massive difference of that, and I think it's probably a bit more. It's easier to access these days with sort of things like podcasts and Zoom meetings, and you can do these things in the evening and online. And I think it's easier to facilitate that type of thing as well.
Cool. So we've talked about lots of scary stuff, lots of different taxes, how it's all very fiddly, and how there's not an exact correct answer for stuff. But am I right in thinking that, as I did a number of years ago, just contacted you and said, hi, I have no idea how any of this works. Are you able to help out setting up limited companies? And can people just send you, as we do, an Excel spreadsheet with some bank statements and go, can you sort that? And then we pay you a monthly fee, which is extremely reasonable, and you sort it out. Is that basically how a lot of people should view it? Because we're very good at what we do, and you're extremely good at what you do, and that's how it works.
No, that's exactly what it is. A lot of people just don't want to get involved, either because it's mind-numbingly boring, as you've heard, or
is it?
just because it's daunting. All of those things that I've just touched on there, there's so much sort of more in the background. And we see some people that think, oh no, the opposite extreme of you just said there, that you think, oh no, I'll do it myself and save the accountancy fee. And it just costs them so much money. They'll get late filing penalties. They'll miss some quirky tax relief or VAT scheme that you just don't know exists. And generally, we know that it will save you much more in our fees using us than trying to do it yourself and saving, like you say, what can be a reasonable fee each month.
And you can offset, I'm right in thinking this, you can offset the accountancy fee against your profit, can't you?
Yeah, of course you can. So again, going back to the logic of you need it to do your work. So yeah, absolutely.
Yeah, perfect. Yeah. Well, that was all the questions from me, unless you've got anything else, Vicky.
No, you just covered my last one. That's what was on my list. I was just, from a trader's point of view, sort of what things are they expected to keep records of and all that stuff, but you kind of just touched on it really. We send all our bank statements over, keep all our receipts for everything. Is there anything else you would add to that,
I think
Rachel?
That's it. I think a lot of the time these days people don't keep receipts because it's a very paperless society. I would always recommend to keep receipts just because HMRC is still quite dated. So if you did get a tax investigation, which is quite unusual, but if you did get an inspection, it reassures HMRC if you can say, look, here's my receipts. You can see that you spent X amount at Sainsbury's at the petrol station, but they do like to see receipts. So I think just keep absolutely everything. Even if you scanned it, then shredded it, just so you've got a copy of it. But just that's your best advice, really. And I would say pay as much through, into and out of your bank accounts as you can, just because it makes our life easier. The way you do it, because everything's on your bank statements. I don't need to be digging through the back to say, go in the door pocket of your car and, find this, that, and the other. So
Yeah.
that's the easiest and simple way of make sure we capture everything.
Yeah.
And again, it just takes we have enough stress from looking at the price of the pound against the dollar. So to have somebody who can take away the stress of, if we do get a brown envelope through, we just pass it on to you. And likewise, as you say, it is very unusual to have a tax investigation. But even if we do have one, you take care of that for us as well, don't you?
Of course we do.
It's all part of your service.
I think the other thing as well, when you've got an accountancy firm stamped on the bottom of your tax return or your accounts, it just fills HMRC with a bit more confidence rather than just Andrew from wherever sending his own tax return that might not have a clue and might have made things up because he's got giddy or, missed things off. That just...
Is that a few beers watching the England game? Carlsberg.
Carlsberg. I'm a trader. At least it's a Moretti.
Oh, I was going to say, That's an insult.
It's not Bollinger just yet.
Yeah, we're getting there. But no, I think it does sort of fill HMRC with that confidence as well, that somebody that knows what they're talking about is submitting your figures rather than just you on your own.
Yes. Yeah. Registered accountant.
Definitely.
Okay, amazing. Thank you so much for your time. We will put all the details of how people can get in touch with you for as and when. And I think also it's often better to have, correct me if I'm wrong, that conversation earlier rather than later on, rather than going, hi, I've been trading for 18 months now and I've made 30K and I should probably do something about it, which, as you say, you're then into late penalties and all that sort of stuff. But to have that conversation before all of that.
Yeah. And we're always happy just to have it's a no obligation chat, real casual phone call, meeting like this. Exactly. You can completely ignore our advice, that's fine. You don't get charged for it, or like you say, it can just save you an awful lot of time, hassle, and money.
It's the peace of mind, which is invaluable. When you've got so many other things whirling around your head and you're trying to fall asleep and you're thinking about a swing trade that you've been in with the Japanese yen for the past 4 weeks, at least your tax is taken care of.
Yeah, at least that's sorted, No, absolutely.
And you don't have to worry about that. So absolutely fantastic. Okay, any questions from anyone who's listening to this or any comments, please just reach out to us on the usual channels, and likewise, if you've got anything else or any guests that you want us to get on to have a chat about, we're more than happy to do that as well. So a huge thank you to Rachel from Freeman Accountancy for coming on today.
No, thank you very much for having me. It's nice to see you.
Cool.
Thank you so much, Rachel.
Speak soon.
Thank
you. Thanks. Bye-bye.